Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This is a second part of a two-part series where I've been really talking about debt and how American corporations have been binging on debt. But I've also been, want to kind of talk a little bit about what the companies have been doing with that debt. And I'm going to keep that exclusively to share buybacks and, of course, dividend paybacks. But primarily in this video, I want to take a look at the companies and share buybacks. But I also want to look at valuation relative to the share buybacks that these companies have been engaging in. The reason for that is because I'm neither for or against share buybacks. Some people are vehemently against it. I think share buybacks make sense if the stock prices are cheap enough. And I think the stock price is way overvalued, then I don't want management to be buying the stock when I wouldn't be willing to buy it myself, because I don't consider them good investments when their valuations are high, even when the companies are good. So let's look at these stocks. Let's start with Altria, which of course used to be the original Philip Morris, if you will, symbol MO. And notice that they've had a very consistent record of earnings growth and a very consistent record of dividend growth. Although they did spin off Philip Morris International, which I'll be covering next, and as well as Kraft and some other pieces. But if you look at this, you can see where the stock price tracks earnings, and then it did get overvalued in 2015, 16, and 17. Now, if I look at what they did with their share count, coming into 2008, they actually issued shares. And that's probably not really a bad idea because their stock price was actually pretty highly valued in late 2007, early 2008. And it wasn't until the depths of the Great Recession where the stock price actually fell at all. But so the company actually raised equity. So a lot of their capital needs have been raised, through equity and issuing common shares. They increased their share count from 612 million in 07 to 1.7 billion in 08. And then I also want you to notice that they've maintained their share count. If I look at this just over, let's say, the last 10 years or so, their share count reduction has only averaged about 1%. And that's just, normal needs of the company operating their business. But if I look at this from a standpoint of valuation, when their share value has been real high here, the company has not been buying back shares. And then finally, since, what I'm really interested here also in this article is the balance sheet, the company's actually increased their book value through 2018. In 2016, 17, and 18, they maintained it for 2009 through 2015. And then they did drop off quite a bit in 2019. But contrary to some of the other stocks that I've covered and will be showing you here in this video, they've actually do have positive shareholders' equity. My second example was also in the tobacco industry, of course, and that is now Philip Morris International, which was spun off from quote-unquote Altria back in 2008. And I want to look at this stock from a couple of perspectives. They've had a pretty good record of dividend growth. Their earnings have been a little spotty in recent years, but as the inexplicable market is sometimes, the valuation actually got very high during a time when they've come off of some down earnings. Now, part of that was because their earnings started to improve a little bit, and so I guess investors got excited, but then we've had a subsequent reversion to the mean. But if I look at this stock from a standpoint of share buybacks, I want to point out, of course, they raised equity in 08, or they were spun off. And then their share count in more recent years has really been relatively stable. They haven't really reduced that much, in terms of shares. And if I look at common equity, though, the company has gone negative common equity or negative book value since 2012. But, I can also attribute that to the amount of debt the company has. They have 162% long-term debt to capital. But nevertheless, the company has been pretty conservative with their share buyback program. The next company I want to look at here is AT&T, and AT&T is much maligned. They've only got 45% debt to capital, but they do have, an awful lot of debt, raw debt, which I guess caused a lot of people some problems. But keep in mind, this company was SBC Communications back here, and then they purchased AT&T and then took on the iconic name. So this has only been AT&T for, roughly the last 11 years or so. In other words, the modern AT&T is the company that has existed since Southwestern Bell, SBC, has actually bought the company. And so, they've had moderate growth, about 4% growth. I consider the stock extremely undervalued. It's got a 6.5% dividend yield, an earnings yield of 10.8%. But let's look at it from a standpoint of share buybacks. Now, I'm looking at this long-term graph. Again, this is SBC Communication. This is the acquisition of AT&T, the new, which is the old iconic brand which the company goes by now. And, they did originally raise shares or obviously produce equity. But I also want you to notice since 2014, the company's actually been increasing their share count. They increased it 8% in 2015, 9.6% in 2016. They did, maintain it or reduce it very slightly in 2017. But then in 2018, they increased their share count by 10%, followed by 8% in 2019. Now, if I look at that, the company has been raising capital during a time when their share valuations have actually been pretty low. So I don't know that that's necessarily something I'm, let's say real excited about or happy with, but at least it's not buying back their shares. Now, what's interesting about that, if I look at this company from a standpoint of book value, they're the only company of the 7 that I covered in this series of articles that have actually been increasing their common equity or shareholder equity, and that's partially a result of issuing shares. So they've kept their quote-unquote book value metric positive during a time when most companies are seeing a destruction of shareholders' equity as a result of debt. But the company does have a lot of debt, but they have one of the best debt-to-capital ratios of any of the stocks I covered in this. And then last but not least, I want to cover AutoZone because this is a very interesting example. Now, this is a growth stock. The company, as you can see, has grown earnings by over 18% a year since 2001. You can see that their stock price has tracked an 18 PE, between a 15 and 18 PE for that entire time frame. I would consider it reasonably valued today at a blended PE of 18 with flat earnings for this year. But what I want you to really notice is this company has been attractively valued throughout this entire time frame. And just to put this into perspective, it's had excellent performance over this time frame. Even though it doesn't pay a dividend, it's averaged over almost 22% a year since July 31st, 2000, compared to the S&P that only averaged 4.8% over that time frame. So let's look at what they've done with share buybacks now by turning to fund graphs. And you can see that the company has been a very aggressive purchaser of their shares. Now, you could argue that's possibly partly explains why the company's earnings growth has been so, strong. But I can also look at the company from a standpoint of total revenues. And this isn't revenues per share now, this is total revenues. And I want you to see that the company has increased their revenues very dramatically, even though they've been buying back their shares. And if I looked at revenue per share, it would look even better, of course. But from a standpoint of common equity or book value, let's go ahead and look at the balance sheet and look at their common equity or book value. You can see that by the Great Recession, they had been continuously shrinking their book value. And then in 2009, their book value disappeared. And they've been generating negative and growing negative shareholders' equity ever since. And that's in spite of the fact that the company has grown dramatically. Now, the moral of the story here, I'm just looking at debt, how companies have debt. This company has 126% debt to capital. They've taken on a lot of debt, as I showed in the written portion of this article. They've reduced shareholders' equity, yet this company has been a stellar performer throughout all of this. So, I think it's important that we look at these metrics, focus on a company's balance sheet. But one of the issues that we're seeing, as I pointed out in the article, is that, balance sheets, it's very, very difficult to ascertain balance sheets, especially in a service economy like we currently are in and have been in for many years, especially considering the fact that we've had this just, consistently dropping interest rate level that we've seen here. So anyway, this has been Chuck Carnival. I thought it was kind of an interesting take on share buybacks, debt, and what that's meant to the company's earnings per share. Hope you enjoyed this video. If you like what you see here, you might also want to take a look at our Dividend Kings marketplace service on Seeking Alpha, where we cover a lot of high-quality dividend stocks, including the ones I covered in this article. Thanks for watching. Look forward to talking to you again.